Hello, everybody. This is Greg Sweeney. Welcome to the conference call. Just a heads up, I try to limit these calls to 15 minutes, but this one might take a little bit longer than that. The topic today is boom, bust, and balance. And the first thing I would like to do is look at the economic narrative that we're going to hear if we turn on the news and any financial network news. We're going to hear that the consumer is strong. This is an important statement because the consumer is about 2/3 of the United States GDP, or gross domestic product. That's how we measure the size of the economy in the United States, is GDP. We're going to hear that the unemployment rate is near record lows. Retail sales are growing. We have record GDP. The Fed is aiming at getting inflation back down to 2%, and that they're engineering a soft landing. The definition of a soft landing is the Fed is able to maintain full employment or maximum employment and take care of inflation, which means knock inflation back down without putting the economy into a recession or any type of slowdown, is what is meant by a soft landing. So the first thing I'd like to do is go take a more in-depth view of the consumer. The consumer is strong, that first statement. This shows that prior to the pandemic, consumers were earning about $28.50 an hour. Today, it's $34.56 an hour on average for employed workforce in the United States. And we're going to see what that looks like on an inflation-adjusted basis in a few slides. The unemployment rate, as the narrative mentioned, is low. It's 3.8%. Prior to about 10 years ago, it wasn't expected that unemployment could remain below 4%. It was considered unsustainable if it was below 4%. But if you look back to about the beginning of 2018, it's actually remained under 4% for most of that time, except for what we saw during the pandemic. So unemployment remains at historical low levels. If the consumers have jobs and they have income, they tend to spend it. Remember, we said that the consumer is 2/3 of the U.S. economy. So here we see what they're doing with it. They're spending it. They're spending it at a rate that's faster than the trend line represented by the green line on this graph. So the consumers are certainly strong, at least by this definition. If we look at gross domestic product, again, this is the total economy in the United States. We look at it pre-pandemic. We look at it today. It's up a cumulative amount of 27.6%. And this is the current narrative. Everything looks great. Jobs, income, economy growing. It tends to fall into that near perfect category, if you will. But what I would like to do is I'd like to spend a few minutes and I'd like to go back to that first slide that we saw. And I'm going to ask a few questions about the current economic narrative. Is the consumer really as strong? Is employment really as good as it says it is? Are retail sales really growing? Things like that. So let's get into those slides. So if we look at real hourly earnings year over year, I mentioned that prior to the pandemic, consumers were earning about $28 an hour on average. Now it's $34 on average. That's a 21.8% increases in wages since 2019. But if adjusting for inflation, you can see that wages are not hardly up at all. Matter of fact, it's spent most of the last 3 years wages growing at a rate that were overshadowed by inflation. In other words, wages didn't even keep up with inflation. And so they spent 2 of the last 3 years moving backwards. So inflation since the end of 2019 was up 20.27%. And as I mentioned, earnings up 21.8%. So on a real basis, wages are only up about 1.5%. How are consumers keeping up when wages are just barely above inflation? They're taking on more debt. Those of you who have been around long enough to remember the crisis of 07, 08, 09, the great financial crisis is what has been labeled now, or GFC. You remember that credit was a big problem during that time. Well, credit now is twice as high as it was back then. In the last few years, credit rates, interest rates were pretty low, but now interest rates on revolving debt is quite a bit higher. Personal savings rate is also how the consumers have tried to keep up with the rising inflation environment when their salaries didn't. You can see the green line drawn through there. That's the average personal savings rate over the last 25 years or so. And you can see that current savings rate is noticeably below that line at 3.6%. So the consumers have been heading towards taking on more credit, and they've been tapping their savings in an effort to keep up with rising costs. Matter of fact, credit, expanded credit and the rising interest rate environment has made a significant dent in the amount of interest payments that households are making. The yellow line on this graph is the interest rate on home mortgages collectively in the United States, and the black line is revolving credit, so credit cards, auto loans, things like that. You can see the interest rate has jumped up to be on par with the interest being paid on mortgages. So consumers have tapped credit in a big way. We talked about employment being at record lows, or unemployment being at record lows, and unemployment numbers, the calculations are subject to all sorts of adjustments. What I tend to favor doing is looking at employment. How many people are actually out there working? And so I've got a chart here of that number prior to the pandemic. It's about 159 million people. Today, it's about 161 million people. So there's about 2 million more jobs in the marketplace. So it's not a significant number, but it is a nice number. But with only 2 million, with an increase of only 2 million jobs since prior to the pandemic, how come we have such a low inflation or a low unemployment rate? Well, and part of the answer to that question is the labor force participation rate has declined. The labor force participation rate measures the number of people eligible to work who are actually out working. Prior to the pandemic, that was about 63.5%, and today that's about 62.5%. So keep in mind, to be considered unemployed, you have to be looking for a job. If you quit looking for a job, you're no longer considered unemployed. So with the decline in population, and the population out looking for jobs, or the labor force participation rate being down 1%, doesn't sound like much, but that's about 2 million people that have dropped out of the workforce. Consequently, this might not come as any surprise as consumers take on more debt. Their credit card delinquency rate is starting to drift higher. It's back on par to the years prior to the pandemic. So we've seen a noticeable increase in that, virtually a doubling of credit cards that are 90 days delinquent. As you might suspect, it also translates into auto loan delinquency rates are starting to move higher. So that the excess consumer debt that has come on consumers' balance sheets is starting to make an impact on their ability to pay. If we look at inflation, I want to go back to the other statement on there. It says, the Fed is targeting a 2% inflation environment. This is a long-term history of inflation, and that blue or the green line I have drawn through there is the 2% level. And the point I'm trying to make is that inflation, while it has spent periods below 2%, does not have a lot of history of being below 2%. Now, this is not a criticism of the Fed. This is just simply the development of inflation over time. And as the narrative right here that we're looking at suggests, current inflationary environment's around 3%, and we do not see how inflation is going to get back down to 2% in any reasonable amount of time. What's a reasonable amount of time? We don't see this dipping below 2% or near 2% really in the coming 12 months or so. So it's possible that it goes back down to 2%, but it's probably not in the 12-month time frame that we're going to hit that number. Now I want to revisit another slide, and that's the gross domestic product slide. And the blue line is on this slide is the one we saw initially when everything was going great. Remember I said that the GDP or the U.S. economy is 27.5% larger than it was prior to the pandemic. Well, if we adjust for inflation, it's 8.3%. And that's cumulative. If we annualize it, that top line 26.7% annualized is actually 6.25%, and that bottom line 8.3 is actually about a 2.02% annualized rate of return. So real wages are up 1.1%. Real GDP is up 2%. We see how consumers filled that gap. They took on debt and they decreased savings, right? But that yellow, you can tell I'm not very good at Excel here, right? I tried to fill in the gap in between those two lines, but I ended up having to use a shape and then change the color of it. The gap between those two lines is simply inflation, right? So the consumer's only been able to purchase goods and services only at about 2.02% higher on an inflation-adjusted basis than where it was at the end of 2019. So, I'm kind of questioning that narrative, right? And I would argue that the consumer has been a bit more marginalized, and they're not in as great a shape as the narrative suggests. They're not in bad shape. I'm just suggesting that the kind of euphoria that suggests the consumers can keep spending probably aren't as accurate as the narrative might make us want to believe it is. So with the consumer in that situation, I think the other thing we want to do is just spend a couple of minutes looking at the stock market, and I'll use the S&P 500. You might have heard talk about the Magnificent Seven. Those are the largest 7 stocks in the S&P 500. They are prior to the pandemic back in 2019, these 7 largest stocks represented about 17% of the overall S&P 500, and today they're 28% of the S&P 500. So you can see that their representation has increased dramatically. I don't know the answer to that. I don't know if it's because of AI, right? The artificial intelligence. Some of us use AI in a different manner, and we call it already irrational. I don't know which one of us is accurate there, but just kind of a little bit on the humorous side. But we're talking about numbers that are about 11% higher than they were just before the pandemic. So is it due to the proliferation of passive investing? This is just investors putting money in the market indexes rather than active investment management. Is it because China is doing so poorly, or commercial real estate is doing so poorly, that investors, instead of putting money in China or commercial real estate, they're directing it to the U.S. stock market through the S&P 500? I don't know the answer to any of these questions. I'm just saying that the largest 7 companies in the S&P 500 has increased materially in the last 4 years or so. Now, the other these are known as the Magnificent Seven. The rest of the S&P 500, the other 493, are basically known as the forgotten 493. Most of the returns we're seeing year to date and last year came from this Magnificent Seven, and not much from the forgotten 493. So if that's the case, we have to start wondering about valuations. So valuations in the stock market are usually the current book value or book value of the equity in the market, plus the expected future cash flows. Now, this example uses net present value of the next 3 years of earnings in the S&P 500, right? Well, if that was the case and the market was priced at book value plus the expected earnings, present value earnings of the S&P 500 over the next 5 years, or 3 years, excuse me, it would be less than half of where it is right now. That gold line that you see on there is what we call the hopes and dreams, or price of the market above what is observable in terms of book value and net present value of expected next 3 years earnings. Now, that might look like it's huge, but we've been there before. If you go back to 2000, right, on a relative basis, the gold portion of that shaded space is more than double what everything is underneath. Kind of like the case we're looking at today, right? Back in 2000, the market sold off, and then it started to rally again in 2003. Then it sold off again during the great financial crisis in 2008. Then it started to rally again. If we look at the peak of that black line back in 2000, we didn't reach and sustain a level above that until 2013, right? So I'm not trying to warn anyone that the stock market is overvalued, the stock market is going to crash. I'm just observing that valuations are higher than they've been in quite a long time. Successful investing relies on long-term perspectives, and you have to stay long-term focused. What I may be suggesting to you here, though, is it's not unusual during times of economic or market excesses like this for investors to get overly aggressive in their overall investment allocation. What I'm saying here is successful investing requires long-term focus, and it requires an appropriate asset allocation. An appropriate asset allocation means there needs to be a risk profile that's consistent with your stage in the investment cycle. In other words, a younger investor can have higher stock market allocations. An older investor that is closer to withdrawing funds from their account maybe can't be as aggressive. So this is just a notice that maybe it's time to visit your overall investment allocation to make sure it's appropriate with your what I call personal investment profile. Summary outlook. I just wanted, these are what I think are issues moving forward. Economic risks appear to be tilted towards geopolitical concerns. I'm talking about Russia and Ukraine. I'm talking about Israel and Iran. I'm talking about the prospects of the conflict between China and what might happen with Taiwan. I'd even say that, the prospect domestically here of the U.S. elections and the what I call the the Sunday afternoon NFL football perspective, our team against your team, in terms of conservatives and liberals in terms of the electioneering going on. Election years typically see economic growth. So throughout this presentation, I don't want to warn you of a pending, economic recession either. I'm not seeing that either because election years are typically years of economic growth. I do expect interest rates to remain elevated. Of course, the market is looking for 3 Fed rate cuts this year. Regardless of whether that happens, I see the underlying Fed funds rate remaining above the underlying inflation rate, which means there will be a real cost of money to borrowers and a real savings rate to savers. That ends up being the case on the longer end of the yield curve as well if we start looking out at 10 years. As I showed you, it might take inflation a while to get back to 2%, and it really may not land there even in the next 12 to 18 months. We expect market volatility to continue. Bond yields do provide some competition to stocks. I mean, think about it. A short-term treasury yields 5%. The long-term average rate of return on the stock market is 8%. Investors can get 5% risk-free, and that 5% is about 2/3 of what you're going to get from the stock market. So investors aren't being punished nearly as much today, hiding out. I call it hiding out in bonds, as they were, 2 or 3 years ago when the 10-year treasury was 1.5% and the short treasuries were 1/4%, right? That was painful to put money in bonds when that was the case. The other thing we see on the horizon that really is not sustainable, and that is federal deficits, which federal deficits kind of beyond the scope of this presentation when I try to get it done in 15 minutes is artificially supporting some of those GDP numbers we saw on previous pages. So real quick, portfolio positioning. How are we positioning portfolios? This is a representative of our equity portfolio positioning. On the slide on the left, or the portion of this slide on the left, we have a higher allocation to domestic than indexes out there. We have a lower allocation to developed international. Consistent with our economy in the United States growing better than developed foreign markets. Our allocation to emerging markets is something close to nothing in this environment compared to the MSCI index at 7.2% of the ACWI. Upper right-hand corner of that slide, large cap, mid cap, and small cap. Our large cap allocation, that's where you see the overvaluations I showed you on earlier slides. So we have about a 6% underweight or so compared to the MSCI World and the MSCI ACWI. Our mid cap is slightly higher. Most of our allocation difference is made up in our small cap allocation. Valuations are better there. And then finally, in terms of growth and value, we have an elevated position to core, a little bit lower in growth, and about the same in value in terms of our growth and value allocation. Just one more quick note, mortgages. I know a lot of people are looking at mortgage rates right now and say, geez, they're up really high, well, let's just call it 7%. A lot of people out there have mortgage rates below 4%. I just simply wanted to point out, I probably should have made the history of the slide a lot longer, but the history of mortgage rates shows them being a lot closer to 6 to 7% than it does 3%. The point being here is the anomaly is not interest rates, mortgage rates that we see today. The anomaly was the mortgage rates we saw for about a 10-year period, from 2022 to back to 2012. So just a quick history there. Hey, thanks for joining us today. We appreciate you taking the time to take in the conference call. Wishing you a great day. Thank you. Bye.